Welcome everyone to the Kendall Report. It is Sunday. Well, looking forward to this week actually. I will tell you that, sorry for being a few minutes late, but I will tell you that I am in the final stages. I finished all of the indicators. I'm starting off here, just getting ready to, we've got the delivery mechanism in place. Everything is automated now. It's been quite the effort, so it's still going to be probably another day or two, but we should be able to get these things finally on the street. And I plan on doing some live coverage on how to use them initially, and then we'll get all the other videos out. Otherwise, it's going to be at least another week or 10 days. So I know that's not going to be acceptable. So anyway, welcome again. Make sure you hit that like button, and we'll get into lots of details what's coming at us this week. So we've got PCE numbers coming. This is the Fed's favorite inflation that they're always looking at. And the title I put in here is Inflation Unraveling. And I don't think it is, but there is a lot of folks that are starting to talk about just that. There is something that's going on that I think has to be acknowledged. We'll call it the elephant in the room, which is AI and the emergence of AI. And that's probably a deflationary source longer term. It's also a multiplier of GDP. I can tell you some of the stuff that you're about to receive from me is because I was able to use ChatGPT and get some of my ideas into code and work through some stuff between a couple of people here on staff. So that's been really super exciting for me personally. I've been wanting something, the ability to do this for a long time, just never had the time to, quote, I'll do air quotes, learn the code, right? That's the key. So I was able to get a lot of these things out, and it's very interesting for me. And I've told you this before, so I'm a big fan. We adopted ChatGPT on a whole bunch of stuff internally, going all the way back to probably December of maybe even November, just when chat started to show up. We really got on that. There have been other times where that was evident in as far as being available, but it's really been a big change. And I think I'm not the only one experiencing that, maybe many of you as well. And I think what it's done is I saw something that I think is important to acknowledge, is that basically something like chat, these are what they're doing is expanding your knowledge, giving you the next level. They take what you already know. If you know how to prompt it, you have to prompt something with some intelligent thought. So if you have some skills, you can enhance those skills. So it's more of a enhancement from that standpoint. So anyway, I'm very excited, but I think this is going to be a game changer over the next couple of years and beyond. So, you know, folks that are looking at, I wasn't an intentional troll or anything, but, you know, I just continue to see some folks out there just super negative, talking about everything. And I want to cover something because I think it's important for everybody to understand. When you take a look at a chart and you go, this is the worst it's been in 20 years, this is the worst it's been in 6 months or year or whatever, when the metrics get so low, it's usually the bottom, not the beginning of the continuation of things. And this is the same thing. This is how people buy the highs and sell the lows. As you see a chart and it's going up, oh, look at it, it's the highest it's been forever, and now you're going to buy. So it's this inverse on all these charts and these metrics that people are going out there and saying this is the worst that it's been for 20 years, 30 years, 100 years, whatever it is. And there's something else going on, because I'll probably get into a little Fed speak here tonight, since we have Powell coming up and we have PCE. But there is, and I've been talking about this for a while, this normalization of interest rates that is going on. There's a whole level of economics that many people have not seen yet. And I'm not super bullish from the standpoint that everything's just going to get better and better and better. That's not what I'm talking about here. But a lot of these disaster metrics that people are throwing out there yet is just laughable from the standpoint of somehow everything's going to add up into this one element, and the market's going to roll over, and that's going to be it. Now listen, I could be in that camp 3 months from now, 6 months from now. Anybody that's been hanging around me for more than at least the last 3 years since the pandemic, but those of you that have been around me for decades, you know I've flipped this coin on in a heartbeat if the markets start to show the evidence that something has changed abruptly. and I'm not going to hang on to my bullish or bearish views beyond the database and all the metrics I do. I have a very systematic approach to how I look at the markets. I kind of walk you folks through every day on at least the high level stuff. And now that these indicators are getting out, you're going to see the new indicators. They're called a suite for a reason, because there's multiple indicators that if you use them together, it really empowers your thought process, your decision process, and where to buy and sell and manage your money. That's really key. And I think that's my goal, is to get that in your hands and to be able to do that. That's why I'm not doing subscription-based indicators, and all I want to do is get these things out. It takes a lot of time and effort to do this, and certainly the money attached to it helps to facilitate that and be able to answer your questions and things like that. So there is going to be a number of things I'm going to be doing going forward that I think you're going to really like. So let's get a little more into some of this Fed situation that we have coming. Now, PCE, we'll talk about inflation here for a minute. PCE is likely to be, it's expected to be 0.4 on the uptick. Year over year is around 3.8 on the headline number. On the core, and this is what Powell is telling us that they're watching, right? So the core expected to be 4.4. That's not 2%. This leads me into the conversation that folks are going, that the Fed, the market's not listening to them. They're not listening and saying, the Fed's saying they're going to raise rates 2 more times, but the interest rates aren't reacting that way. They actually are, and I think there's a misinterpretation. I won't get into too much detail. I may fall back into this hole once we get into the interest rates, but the scenario that's happening here is really just a normalization of the economy after almost 15 years of artificial rates being induced into the marketplace. And now we're trying to get into a more normal range of how interest rates are going to work, and the markets are going to drive them, not the Fed. The Fed's not going to panic and lower rates, and it's going to be different going forward. We'll see. Many folks aren't buying into my scenario. Some of you are. But the point is that's how the markets actually will function much better. And that means we're going to have volatility in interest rates. It's not going to be controlled like what we saw for years, where they were artificially held down to these very, very low rates. They're going to be floating. And that's going to be interesting for folks to go. And when the Fed does make a change, it's going to be relative to the market. They're going to adjust to the market. So don't be sitting around expecting, well, the Fed's going to pivot, they're going to do all this stuff in the market. No, they're quite happy. I think the economy would really have to come off the rails to do something like that, and there would have to be some event to happen to trigger that. I know folks are talking about, well, we had a banking crisis. Actually, no, we didn't. We had a couple banks that were very mismanaged and very poorly managed, and we had the first signs of the digital world of a run on a bank. And this was generated by people like Peter Thiel. And, when you go out and take billions and tens and hundreds of billions of dollars out of a bank in one day, you're going to disrupt it. So these are not, I guess the best way to put it, these were not situations that was the banking crisis of any sort other than a few banks, and they were reasonable sized banks. And it's the irony of it. Once upon a time, I almost got an apartment that in the lobby of that building, it was the Republic Bank. So it was kind of interesting scenario. So that was back in the 90s. But the point of what's going on in the economy right now is things are still reasonably stable in spite of all of the noise that's around here. And the this normalization is going to take a while. And I think just trying to put together everything I'm talking about tonight is that you've got AI, you got productivity, numbers changing in the background. I know people are talking about the hours worked are going down. Maybe that's because of productivity. There's other things, you know, M2 is collapsing. There's that story out there. And meanwhile, you have to look at the velocity of money as well to see what's going on there. So there's just a lot of shifts, the way that folks are trying to, you have to realize that people with an agenda, it's a lot easier to sell the negative scenario than to be bullish or positive. And the only reason that, just to summarize this, that I'm actually bullish at this point in time and have a longer intermediate term outlook that is positive is because of our database. And as you'll see here in a minute, I'll cover the database on Sunday because I've got all the accurate numbers, that there is some attrition starting to happen, and we're going to see some short-term backfilling, and I'll talk about all that in the technicals here in a minute. Let me go back to my notes. I know I'm kind of rambling on here a little bit, but as we come into this week on Monday, tomorrow we've got the new home sales. They're expected to be 680,000. I think that'll be reasonably stable. I still starting to see, especially in the new home sales, these are first-time buyers and they're not the higher-end stuff. There's plenty of rotation and dynamics going on in the housing market. Then we're looking at consumer confidence coming out at 104 is expected. We got durable goods minus 0.9 and the Case-Shiller index. So they're looking at real estate prices to continue down at a rate of 2.7%. I think that's interesting. I set something up in a couple areas on Realtor.com, and I hearted a whole bunch of different properties in areas that were hot and different regions across the country. And there have been a lot of price drops on a lot of this stuff. So there's definitely downward pressure. But we also, if you think about it coming out of the pandemic and going through that, things really got really hot. So everything, because of this interest rate situation I'm talking about, is normalizing. So ultimately, the markets will normalize and we'll understand a little bit more about what's going on rather than the expectations that Jay Powell and his group they're going to run everything like what we've seen in the past. And I've been telling you this. I know you folks are maybe tired of hearing it, but I've been telling you this for a while, that this is how it's going to work. You know, you'll just keep watching. You'll see. I would, like I said, only some major derailment would cause the Fed to do anything to the contrary. So let me go through. So Wednesday, we get to hear, speaking of Powell, we get to hear him talk again. Tuesday, we've got the only thing coming out on Tuesday is mortgage apps. Last month they were up 0.5. We'll see what that looks like. I don't think that's a material number by any means. And then on Thursday, we've got the typical claims, 268. Continuing claims last week were 1.759 million. And the other thing that comes out is the third revision of GDP, expected to be 1.3. I wrote down a note here. Nobody cares. Deflators coming out as well. That's not going to be anything material. We pretty much know all these numbers, so nothing there. On Friday, we do have the PCE numbers, so let's get to that, and I'll finally get through this opening riff from that standpoint here. But we've got PCE, like I said, up 0.4. It discussed as 3.8 on the headline, and then on the core is what the Fed's watching. That's expected to come in year over year at 4.4. Maybe it downticks a little bit, and that'll be a positive for the markets. You'll see here in a few minutes, I'm looking for short-term correction here. I mentioned that on Friday's stream. We did have some downward pressure. I still think there's elements here that we need to watch for on a short-term basis, and I'll go through all those details here in a minute. Just looking at one last thing, I just want to cover and then we'll move on and get into the database and into all the technicals. I think I'll be able to get through that stuff fairly easily tonight. So let's take a look. S&P was down 1.4% last week. It's up now year to date 13.3. NASDAQ was down 1.4 as well. It's up 28.9. And the Russell was down 2.9, and it's up 3.4. So that basically took about half of the returns of the Russell. And I just want to cover this. I know I've been going on here tonight, but the other thing that's happening is that the banks are coming back under pressure. There was a fair amount of talk when Paul was talking in Q&A and stuff. There was some things that came up about the banks that folks are starting to focus in on a little bit. I don't think we're going to get into any major collapse, but those indexes, I won't go through them, but the KREs of the world will most likely see a little more downside. But there was a decent run on them. Now we're getting a correction, and we'll see how that sets up. So I've got my eye on it, just not going to focus on it tonight. So let's go ahead and let's get into the database and start getting this thing going tonight. All right, so this is the daily database. I'll start there. Not a lot happened on the weekly. I'll discuss it, but I'll give you some of the numbers here. And the daily had, for tomorrow's opening, 2,239 sells, a combination between 1.2 and 3.2, and then it had 186 buys. So we're seeing that percent. We got up into that 64-65% range. And now the numbers we're going to watch for, my notes suggested that we could fall back into around 58's a number out there, but I think we'll go to 52, 48. I think we'll see a decent backfilling here. And I think best way to look at what's going on here on the short-term database is we had a nice run. We basically, went from, we'll call it 3,800 to 44, and now what we're getting is some consolidation. I think as long as we stay over 42%, that's good. If we drop below 42%, then that's going to suggest we're getting a little deeper correction here. And I think the markets have gotten to the point where they've been positive enough that it also pulled into a bigger bullish consensus out there. And I think what we're really seeing here is the beginning of some more of a rotation, and that's more obvious on the weekly or the intermediate models from that standpoint. And what's going on there is basically nothing. We're at 63.44. Let me just go full screen here, and let's click over to this. We're at 63.44. If I go back to the numbers here, on the far right, I went full screen so you can see over where it says position overview over there. We're really looking at, as far as the run went for this weekend, 407 buys, 382 sells. Complete rotation. Basically, the percent bullish stayed very similar to what it was last week. I thought we might actually pick up a little bit. We did not. I was thinking that we might push up to about 68, 72%. I still think that is possibility, but if I'm right about what's going on in the markets from a technical viewpoint and what's likely to go on in the daily models, then we're probably not going to get those kind of numbers at the moment. So we're most likely going to see some little backfilling here, but we should stay well over around 62%, maybe is the lowest on the intermediate is around 58, 56. But we could see some work in here because we've had a pretty steady rise. And one of the things, if you recall, you've been around the channel for a while, you go back several months ago, what I was talking about, we're about to complete, this is the final week of the first month of Q2, of Q3, I'm sorry. And when we get, this is the place where I said we need to watch very carefully what's going on, because this is the potential as we come into the quarterly charts, which I'll cover when we start the beginning of July. I'll go through that. But this is the point in time where you really want to be paying attention from the standpoint of what's going on with the database here, and just make sure that the metrics stay reasonably within the expectations of what I'm talking about here. If we start to fall out of those, then there could be some other elements to come in and maybe some further negativity. But at the moment, I'm expecting a pretty typical, I call rotation, maybe minor retracement range. And that's what I'm looking for as we come into the next several weeks, because we've got, it's going to be interesting. We come into the next Fed meeting, whether or not we're going to get any increases. So the reason why I brought this page up is I just want to bring up just one thing before we go on, is the percent fulfilled on the intermediate is now 25%. On the optimized, you'll see, you should be able to see my cursor here. And in fact, let me just go ahead and draw this in. I want to spend just a minute or so here just to emphasize what's going on here. But this would be this area right here where I just drew the box around. That is where we want to watch, where the current is 51 days, the normal is 205. So there's still lots to look forward from the standpoint of expectations of the database. So I would not get too negative here, but there is likely to be, I think, some work to be done. And we've pretty much satisfied most of those Fibonacci targets I talked about. There was one just around 4,500. We could still move up in there. It doesn't have to be very much going on from that standpoint. And so this is the general expectation here. We still have lots of forward looking. Usually, typically, whatever term you want to use, we don't derail on a trend at this point. It's certainly possible. There's always that possibility, but that's why I'm setting you up to watch these dailies and watch some of that attrition and to make sure we stay within normal ranges of the rotation. And you have to know here that I have gotten from I've been following this database. It's my database, right? But I've been reading this thing for literally 25 plus years, and I'm pretty good with figuring out what looks normal and what we're likely to see going forward. So let's go ahead, let's get into the technicals on the S&P. All right, so here we are at the hourly. Get a couple of things on here. You can see this, we've been just drifting here for a while, and we're just rolling over. We're continuing to see this downward mode here. You can see, this is the one of the new indicators, the Wavetech trend probability. So it's still telling us that right now, these are stacked in order. So this is the 38 is for the 10, the 46 is for the 21 and 22%. So we have a very high probability, since we're trading right at these numbers here, of staying at or around, or most likely below those numbers. And you can see the downward slope here from the standpoint of the angle of attack is still negative. And we're at a minus 0.21. This is on an hourly basis. And there is a little bit of a a potential bounce around the London Open. So watch for that if you're watching this video later, or if you're up trading that, then be cautious around there. We should see a little rally up into these moving averages. It doesn't currently project that a lot's going to change, but it does suggest shortly after London Open that we could get into a positive configuration on the moving averages from that standpoint. Let's go over to the daily, and I showed you something on Friday. Let me turn something on here real quick. I'm going to put on the what I call the market flow indicator, and you can see I mentioned this. I'm just going to bring this over so you can see it. Let me get rid of these probabilities just for a second here. But you can see the market, it's been really, really good. This works off the Wavetech webs. It's looking at directional movement out of the regression lines. There's 20 of them. So it's definitely seeing this. I've been telling you for days that we're probably going to see a move down to around the 21 period moving average. That upward slope's pretty good, but look at the algos on the, and I've got them stretched out right now. So we're looking 50 bars into the future, both on the what's called the WT auto regression prediction. So this dotted white line is for the 10 period moving average. It's showing that ultimate crossover, and the only way that's going to happen, we're going to need to close and remain below those values. So those are things that we're also going to have to look at. And this would go play hand in hand in the scenario I just painted out to you from the standpoint of the moving averages, and everything is we're starting to get into a bit of a correction. And so we've seen the flow change. I'll be watching this pretty closely here from that standpoint. But right now that came up on Friday. If you recall, when I did the video on Friday night, it was showing that we had some potential downside, which we did have on Friday, and we've got a little bit of a green/blue bar here going on. But if you look at the algos, everything's trying to roll over, but the PPM2, which is this red one in the middle, is still at 0.29, still in trend mode. So we're not going to just break down. There's not going to be a big collapse. I would look for a tradable bounce off of that level. That should be a place where if we get down there in the next couple of days, that there's going to be a tradable bounce. I think on maybe that coincides with Jerome Powell talking on Wednesday. But it does look like we got a couple of days. We should be able to get a bounce off of there. And like I said, I'll be covering the database won't change when I come up and with you tomorrow. I just won't have the updates from Monday. They won't be that important depending on what happens. But as I go through here, you'll see that the expectations for Monday are reasonably limited, at least as we come into this week. And so let's take a look at that just a little bit. If we're looking at the market grid over here, what we're looking at is the potential for the S1 is 43.80, where we've traded 87. So S2 is 43.70. I mentioned some numbers last week, if you recall, as we came in last week, around 43.60. That's going to be a number. I'm going to bring up the weekly chart here in just a minute here. So let's go ahead and do that right now, just so you can have that perspective. But look for probably R1, S2 for today. The weekly, you can see we're also seeing this rolling over of the indicators. You can see they're starting to roll a little bit, ultimately suggesting we're going to test the 10-week moving average. That number right now is 42.76. So that's a decent number. That's well below the 43.60. So I think there's more in here if the best thing that you could hope for from this standpoint is that we get a consolidation around this, above this 10. It's still in trend mode plus 0.55, and it looks like it's going to stay like that for another week or two. So this upward slope will keep a general sideways with a positive. So that's why this bounce off the 21 is probably a tradable bounce off of that. If you're a trader, you want to look into that range of trying to find a location there off even the market grid numbers or off the moving averages are going to be quite helpful. I see somebody requesting to cover the dollar. I will do that. All right, so let's keep moving on. From this standpoint, I'm not going to go any deeper on this. Maybe as we go through the week, depending on what kind of movement we get, I'll maybe dig into the monthly. But most likely next Sunday is when I'll go into depth and we'll cover the quarterly. We'll do the big deep down in the intermediate and longer term trends as we come into the second month of Q3. So let's go ahead and go over to the NASDAQ. All right, so this is the weekly chart of the NASDAQ, and this angle of attack just does not want to quit. So all of these markets still have a bias to the upside. The S&P, the NASDAQ, the laggard or the odd one out is the Russell. It just can't seem to get out of its way. There's just lots of issues going on in that small cap sector. So the rotation I was hoping to see has not shown up in a material way yet. And I've been talking about that for the better part of the year, I guess. And there's been stabilization in the Russell. I'll cover that in a minute. But the NASDAQ just, I mean, look at this angle of attack. I mean, this will change pretty substantially, but it's projecting out in the weeks and weeks ahead of a rising 10-period moving average. Right now it's 14, we'll round up 14,300. And we did get a downtick on the market grid on this a weekly chart. So that suggests maybe we can come down. Maybe there's a test coming, which is a pretty decent number. We're trading 15,086 with the possibility of maybe getting down to 14.3. That's a pretty decent correction. That could be maybe it's not going to happen in a couple of days, but we'll probably see something like that over the next 2 weeks start to come in and test that 10-period moving average. That's what my expectations are from that standpoint. But still, I mean, look at this trend is the gift that keeps giving. It just doesn't want to go down. And maybe that has a lot to do if we were to break down and look at some of the FANGs and some of the big cap stocks that are in this index. They're just continue to be driven higher with the Apples and the like. So let's go to the daily just for a quick expectation here. And you can see I've expanded this so you can see what everything's flattening out here. So this 21-period moving average, just like with the S&P, I'm looking for a move down into that level. And if we get that level, then there's probably a tradable bounce off of here, primarily because you're really looking at the 40-period moving average is closer to the value of the 10 on the daily, of the 10-week. But we're not going to get down to that. We should see consolidation above this 21. The 21 right now, if we look at the PPM2, is at a 0.46, and that is trend mode. So like I said, I would look for a tradable bounce off of the 21 period, both on the S&P and on the NASDAQ. All right, here's the Russell. Well, it's managed to move out of its range a little bit. We're coming right back in there. And I've mentioned this before, as the Russell seems to be leading us. This looks like we're ultimately going to head toward the 40-period moving average. If you look at the numbers here, though, we're negative PPM1, and PPM2 has still got a plus 0.1617 now. And it looks like the only thing you hope for, if you look at these projections, let me blow this up. You look at projections, let me draw something in so I can focus you in. And this is where these predictive tools come in really handy. Well, is it kind of draws where things, kind of gives you an expectation here from that standpoint. But we're probably looking at market staying in this range here, coming down, testing this, all of the averages in here, the 200, all of that stuff is likely to be in the pattern. And this is just not anything robust. This is the daily. We go over to the weekly here. It's just more chop. It's still in the range. So once we broaden out, we zoom out a little bit, you can see we're still in that same range that we've been in for a year. So there's been no movement whatsoever. This is some of what you're hearing out there. A lot of people are like, oh, it hasn't moved, so that means it's negative. I mean, that's the thing. Is it distribution or consolidation? That's the big question. And right now, it's difficult to come up with that. When I go through the monthlies, maybe we can pick up some patterns next as we come in next week. It has been a while. I'll cover the dollar here. Been a little while since I've done this. This is weekly, probably all I'll look at. The dollar still has this interesting profile. You can see that there is, the algos are suggesting we're going to see some downside, but most likely we're going to get just trading along these moving averages. Right now, they're almost all the same value, a little difference. 102.86 is the 10. This is weekly. 21, 103.11, and 104.78. So that's going to be a reasonable range to expect from that standpoint. We did get down to, week before last, we got down to the STX level, got a little bit of a bounce, but I would look for the market grid from the standpoint to drive probably S1, R2, maybe S2, R2 in the range, and that would put us at 102.54 on the upside, 103.55 range, and maybe there's some around there, but I would definitely look at that. I'm just going to go to the daily real quick. The daily is actually saying we're likely to increase. Maybe we're trying to move back up to this range around 104, maybe get back and test the 200. But for the most part, it's a sideways range. Nothing really drastic happening from that standpoint. I think I pressed the interest rate button last time when I did that, but let's go. All right, so this is the scenario, and I'll try to touch a little bit more on this. I think I'm pretty sick of hearing about the inverted yield curve and how the end of the world's coming. Inverted yield curves, I think, probably do mean something, and when the market rates are setting things, not when it goes to my scenario, that really what's happening here is the Fed is normalizing rates. So now I guess the best way for me to try to break this down from the standpoint of what's going on with the back end of the curve is this has more to do with demand and why they're lower. The real estate market is a primary. Everybody knows the issues with CRE. There's so much. I could do a whole broadcast just on this itself, but I'll try to consolidate things the best I can. But what we're seeing here is stable rates in these ranges. And from a weekly, this is a daily, it looks like we're just going to continue to stay within these ranges. Let's go over to the weekly so we get a little better forecast there. You can see here, well, we look at the ranges. We've got a plus 0.60 on PPM1, PPM2 is 0.28, PPM3 is 0.53. So we have all upward sloping trends here. So I think I still am expecting to see some of these markets move up a little bit more. Let me just, let's go to the scripts. Let's put the Fib projections on here because I did not have those on the other markets. But let's, there was, for this week, there's a new downside that's being projected here. But it looks to me that from the August standpoint, we've got a couple more weeks. We're going to stay above these 10. We came short of satisfying this upward fib target, which is 401. This is 10-year. So but it's really being projected to be stable. This is fantasy land out here 20, 30 days out. But from the standpoint of just looking at the next couple of weeks, everything looks like it's going to stay above first, second derivatives on the PPM 1, 2, and 3 is a little weaker, but that's kind of the formation that's rolling over here. So I would not put a lot of weight on that at the moment. But we are seeing basically stable rates that are likely to continue on the 10-year. And I've continued to just go on and say, 361, 365 on the downside, 378, 380. You're just kind of bounce around in there. I don't see anything changing from that standpoint. Let's take a quick look at the 2-year has a little bit different view from that standpoint. It's still got an upward slope. And what is it that the Fed's focusing on? They're focusing on the short end of the curve. That's where the 2 increases are coming. So people are saying, well, the market's not pricing it. Well, it's being forecasted that rates are going to continue to rise here, even on the 2-year, especially on the front end. That's where they're pushing this thing. And the fact that we have this inversion does not mean that there's a recession coming. I'm still arguing the same point over and over, that it really is, what you're seeing is this normalization, and they are focused on that front end. They are focused on the inflation, all of that, and they're letting, for the most part, everything free float the best they can. If you look at, just real quick here, if you look at what's going on from the standpoint of all of these auctions are 2 and 3 times oversubscribed, every one that's happening. Remember the liquidity crisis that was supposed to be happening right now? Let me check. No, nothing's happening. And the reason why nothing's happening, because there's so much money out there that wants treasuries. And I think this is a round number. Somebody's going to correct me. It's okay. It's a number that I saw that's just kind of stuck. So I don't know what the accuracy, but I think they've already raised 300. I think the Treasury has 300 billion in it now. They're going to get their $1 trillion. It's not going to be a problem. Based on the auctions they had and based on the money they've already raised, they could have already raised it. It was there. People wanted it. So the whole scenario that I keep telling you, that there was going to be no liquidity crisis. I mean, I just thought that was the funniest dialogue I've ever heard in my life from that standpoint. And there's just the appetite for Treasury, especially on the short end, is big. But they did, what was it, a 20-year auction the other day? It was way oversubscribed again, folks. And the tails and the normal stuff were pretty decent for the most part. Some of them look to be a little sloppier from old guys like me that watched when we used to see a 2 or 3 tick trail on some of these some of these auctions. They're much wider now. You got a different way of the way these securities are bid for, so you get a little more volatility. So just expect that the front end will stay firm. The back end looks like it wants to try to be sympathetic and move up a little bit. Still have kind of projections for the 10-year to hit 401. I think this is probably one of the most interesting markets out there at the moment, and I've been trying to figure this one out for a while here. I was just looking at the money flow. You can see it had a nice short signal here, and it's picked up where things are trying to turn up here, but you can see the algos are actually looking at from the standpoint of what's expected is they're going to be under more pressure. We're still going to see some of this stuff move down, and we've got these Fibonacci targets below here, which are interesting because below 65.20, and right now we're at 70.04, okay? So a little bit of an uptick here, but the downward targets right now below 60, if you get print below 65.23, 58.24, 53.92. What we've been seeing out of these Fibonacci targets, we've been getting to Fib target 1. We can go back in history. All of these have been hit. Basically, we're bouncing between around Fib target 1, worst case Fib 2, which would put us at the that 58 number I was just mentioning, 58.24. So maybe we print down toward the 60 number, something like that. But the angle of attack is down. This crude oil is in a downtrend, and there's no denying that. This is the weekly chart. And let's go over to the daily just to set up for the short term here. The daily also has a downward slope. You can see nothing being predicted other than more of downward slope and staying probably below, we're going to call it below, just trying to get some numbers here, probably below 71.30 is going to be the upper end of that range. So this is definitely just continuing to flow downward here. So there's nothing else to that. All right, we'll go to gold next, and this is the daily gold. We're continuing to see a similar pattern here where we're just drifting lower. And what was the lowest we printed last week? We got down to 1919. I still think we've got a shot at this 40 period moving average. It's rising right now, so that's at 1856. Maybe it ends up to be 1870, 1850 range on the downside, but we definitely are in a downtrend. This is the daily chart. Let's go to the weekly. If I recall, it's a little more dramatic. Yeah, you can see that the Fib target, which we hit, the Fib target 1 was 1921. We printed 1919, so we hit that. And now, as we come into this week, there's still downward pressure building here on these averages. And the 10 period moving average at 1021 is going to be your resistance point. So we're going to call it 1950 to 1975. Look for rejections if you do print up into there. And ultimately, I think we end up down around this line here, which is going to put us down in that range I was talking about. 1875 is the 40-week moving average. I'm just going to hit the button to look at the monthly, and monthly still has an upward slope, but we probably need to test that line 1858. So we got 1815, 1858, 1875, we got a cluster of numbers down there. Everything is saying we're going to there. So maybe by then Peter Schiff will get neutral, which means it's time to buy. I was gonna get my Peter Schiff comment in. All right, let's, I just happen to have the monthly chart up. Let's take a look at this. The algos aren't able to predict this. I have to change a lot of metrics, but it's interesting. There are upward Fibonacci targets that are suggesting a retest of the highs, which this probably isn't very popular, but let's just look at that Fibonacci target here. How about 55? We'll round off 800, 71, and 80, predicting a new high. We've had these. This was an island projection. Now we've had multiple. This is a monthly chart, so we've had multiple months where this is setting up, and we're looking at ppm1 at a plus 4.6, ppm2 plus 3.43. So these angle of attacks here are huge. The only thing that is got a negative here, which takes months to fix, is the 21 period moving average 31.4. We're going to round off 31.4 is the resistance point. It's also the top end of the market grid as well. 31.782, 33.1. Let me get this number, 33.191. So this is monthly. This is a little bit different look. But when we go to the weekly is confirming that, and I've been talking about this, that we're going to climb this angle here, and everything is trying to improve. And if you look at just the value of this 10-period moving average that's being projected out weeks in advance, that the moving average is going to be 30, into the 33, 35 level. So chances are markets are going to be above that level. So some of those numbers may not be that far-fetched. And you can see the PPMs are all trying to turn up, being forecast for things to get better. Quick look at the daily. We'll finish up tonight's stream. There's a nice angle of attack on the daily. We did get an RTX sell signal, so we should get 1 to 2 days sideways. We've kind of finished that, although the short term looks like we need to probably test the 10-period moving average 28.6. That's rising a little bit, maybe 29.7. That should hold in that range, and then it looks like just like with maybe some of the other markets we looked at, that we're a little frothy here, and we should start to see the short term come into play. But all the longer term charts are suggesting that there's a bigger trend unfolding there. Okay, folks, that'll do it for tonight. Thanks for hanging out. I hope that was a good setup for the week. What I just gave you some pretty heavy thoughts on all of the inflation, the Fed, and all that stuff. So if you like this content, remember to hit the like button and subscribe, all that good stuff. So look forward to seeing you tomorrow. Of course, as we go with this new time starting at 6 p.m. New York time, that does not give me the ability to see the database before I come live, which is the only downside of doing this earlier. And that was the only reason why I was doing later streams, was to get that data. And so far it's worked out okay, being a day and a leg. It really hasn't been that significant. And maybe if there is anything, if you follow me on Twitter, if there's anything that comes out after hours that's earth-shocking, then I will let you know. And I appreciate everybody hanging out here. Thank you so much for being part of this community. I'm anxious about the new indicators. We're going to do our best to try to get a Discord situation going so that we can all, there's one indicator that I'm releasing that's very experimental, and I want to put it out to the community to look at. I've done a fair amount of work with it. I'll tell you what I've done, and then I'm anxious to see what you will do. I think it'll be a fun community effort to look at a couple of these things I put together. Anyway, folks, thank you so much for watching tonight. We'll see you tomorrow.